Hey guys, there is a common question which is looming across all the newspapers. There had been an interest rate where all the central banks across the world are increasing their rates. What is the reason because of which such a scenario has actually prevailed? The answer is very simple. At the time of COVID, there has been an overprinting of money by all the central banks, as a result of which it led to an inflation. Along with that, because of the Ukraine-Russia issue, there had been a disruption in a lot of supply chains, because of which there had been a supply side inflation. So, in order to tame down the inflation, the central banks have started raising the interest rate so that they can squeeze out the excess liquidity which is prevailing across the world. Now, in the rising interest rate scenario, are the central banks competent enough, or have they basically been successful in curbing the higher inflationary trend? The answer is, to a certain extent, all the central banks have been able to tame the inflation, though a lot is still left to be done. Because of the rising interest rate scenario, there has been a unique type of scenario which has been created. For example, the home loan interest rate have also increased at the same time. The borrowing cost, where the corporates are borrowing from the central banks, have also gone for an increment, where the rates have been hiked. And at the same time, all the fixed instruments across the world, the rates of those fixed instruments have also got increased, including India's 10 years G-Sec papers, which are now trading between 7 to 7.5%. So the investors are a little confused that how should they be investing in their portfolios, and what type of scenario should they feel is feasible enough for their portfolios to grow. The answer is very simple. Firstly, because of the rising interest rate scenarios, the debt funds are doing extremely well. Whether it is fixed maturity plan, whether it is target maturity plans, investors can invest their money into such funds. At the same time, whenever any central bank increases a rate, it is seen that the market goes for a toss. So this is a good buying opportunity where the investors can invest their money during the dip phase. And at the third level, the investors can hedge their portfolio against gold. It is always said that gold always acts as a very good asset class against inflation. So by investing your money into gold, you can also hedge against the inflationary trends which are prevailing in the current scenario. So now the question lies that when could we expect a certain stability within the funds or within the markets at large? So for the next 4 to 5 months, till the time the central banks are not getting over with their rate hikes, markets could be in a little choppy shape. However, it is expected that the markets will stabilize after the central banks all across the world are over with their rising inflationary trends. So, in order to know basically which are the sectors and which are the stocks where an investor can invest their money during these rising interest rate scenario, watch us for a forthcoming video which is over the same topic. So, stay tuned with MoneyTree Partners.